Hi, and welcome to this morning's early global view. It is currently 7 a.m. on Monday, December 21st, and this will be our last video analysis for 2015. The next will be posted on January 4th, 2016. So, Merry Christmas and Happy New Year to everyone. And speaking of Christmas, the question in the market from Friday is, did Santa just get run over on the weakness below some key supports by the March S&P future? And the answer is, well, maybe, but maybe not. We'll have to see on the subsequent activity around a key level. So, what does all this mean to the markets? Well, we'll get back to the breaking below levels later, but for right now, the S&P 500 March future is at 2007, up 15 on the day. It's been up as high as back up in the 2010 area. Now, what's important about that is you'll note going back into the 11th, going back, in other words, to Friday a week ago, you're looking at a downward acceleration out of its overall channel since the highs, and that downward acceleration was right here in about the 2016 area. Now, those of you who've been watching our analysis regularly know how important the 2015 area is as the significant weekly chart channel, major channel down break from back in August. So this looked pretty bad. But then last week, anticipation of a friendlier Fed and the temporary stabilization of energy prices left this turning back up after an upside reversal, short-term intraday upside reversal from 10:30 in the morning going back to last week Monday, and that was from the 1990 area. Now that's important because 1990 is one of those old internal congestion areas, and it forms a natural buffer below the bigger supports in the 2010 to 2020 range. And there's reasons those are the range, $5 either side of 2015, that are important. If the market should fail, the bigger lower supports are down the 1975 to 70, with further support below that not until down in the 1960 area, and then in the low 1900s. So it's very important where this market holds on and ultimately claws its way back above, pardon the pun, 2010 to 2020 as part of the Santa clause or Santa portfolio manager reasserting itself. Higher resistances would remain up at 35 to 40 initially. That's what was so important about this failure going back to late Thursday. Then the 2058 to 60 area, and again, all of these are lead contract levels that now the March has taken over after December expiration last week, and ultimately 2075 to 80, which has been a big barrier, as we shall see on the intermediate term charts. But for right now, the bias ostensibly is still to the downside with both hourly and 30-minute MACDs below their lower runaway bands. That's another point about recovering back above 2010 to 20. If it can do that and stabilize, it can get back above this lower runaway band and signal the market can at least trade nominally steady or even push higher again. If it fails to get back above 2020, we have a feeling it remains bearish, and we'll be revisiting the importance of 1990 and those lower levels we just mentioned. And that pretty much does it for the short-term view and mention of the intermediate-term levels for the S&P 500.